I've instructed my people not to do any debt beyond 9 months or so.
Trump just announced Treasury's version of QE. This comes as continuing unemployment claims are jumping more than expected. 1/3 of housing market is seeing home prices fall, and yet Jerome Powell is refusing to drop interest rates.
The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
Trump is obviously not happy about this, and now he may be taking matters into his own hands. Listen closely to the comments he made Friday that has analysts basically melting down and the stock market hitting all-time highs.
Because Biden gave us a lot of short-term debt, and given the short-term debt, he did us no favor. So I think what we'll do is we'll probably just extend the short-term debt and then go up, because I don't want to tie it up for 10 or 15 years at a high rate. And a stupid person that is making a big mistake, he's making a mistake. And it lasts for years, because when you do the debt, now I've instructed my people not to do any debt beyond 9 months or so. Get this guy out, and whoever is in there will lower rates. If I think somebody's going to keep the rates where they are or whatever, I'm not going to put them in. I'm going to put somebody that wants to cut rates. There are a lot of them out there.
Did you catch the significance of what Trump just said? He's essentially announced plans to issue primarily just short-term debt, a policy that started during the Biden administration at a much higher rate than even Biden did with Yellen as Treasury Secretary. Now, Stephen Myron, who works in the Trump administration, said this about the tactic last year when Yellen was doing it.
So it really works through a lot of the same channels that QE does and allows the Treasury Department to effectively implement what's a stealth QE program in terms of its effects on markets and the economy, but from Treasury instead of from the Fed, and thereby begin pushing up other forms of other asset prices as well.
Listen to what Andy Constant has to say about this instruction. Just to be clear, this instruction resulting in the cancellation of $3.3 trillion in coupon auctions over the next 9 months would be an annual pace of $4.4 trillion of QE, or double the monthly pace of any QE in history. This could create massive downward pressure on mortgage rates. Now, it's hard to know if Trump is serious about his plans for the short-term debt, but it's no coincidence that the NASDAQ and S&P 500 are hitting all-time highs. Even though it might feel economically tough out there, they are basically printing a massive amount of money through the Treasury this time instead of the Fed. What actually does this mean for housing? Well, let's talk about housing, and then we can come back and talk about the timing of this. Now, when it comes to housing, there are a lot of housing headwinds out there right now. Eric Finnegan from John Burns Consulting called out housing formation risk. This is probably the most important metric that nobody ever talks about, and yet he's saying it's slowing, possibly signaling fewer buyers and increased vacant homes. Lennar's incentives are as high as they've been going back to 2009, and Guy Berger just sounded the alarm bells on continuing unemployment claims breaking to the upside. In fact, many analysts are now predicting flat to negative home price growth for the year. But I'm not so sure that this is going to turn out like everyone thinks. For one, look at this Twitter post that I posted on Redfin Active Listings. Some of the weakest markets are starting to see inventory declines. Markets like Phoenix and Naples saw noticeable drops in active listings. And sellers are frustrated, and they're not distressed. They're pulling their listings off the market. This aligns with what Redfin calling out. Some would-be home sellers are stepping back as the market tilts towards buyers. Now, this is before Trump does his Treasury intervention. If he were to intervene, we could see mortgage rates drop and demand potentially skyrocket, albeit from very low levels. Keep in mind, sellers that don't have to sell are just stepping back for a third year in a row. Now, Nashville active listings are up 33%. But even here, the trajectory is slowing rapidly. This week, active listings grew 74. On the same week last year, it was 111. If this continues, we could see a seasonal inventory peak much earlier than last year. And this is with demand down 4%, a very surprising number given just how slow things have been. But the median price still doesn't appear to be dropping, as Parcel Labs ranks Nashville and many other markets as stubborn. And the median contract price per foot here that I calculate remains well above last year's levels. I was for sure that it was going to break by now. But with so much inventory on the market, even though from an aggregate perspective, prices aren't moving a lot, there are a lot of locations and types that are having massive changes. You see, as more options become available and demand continues to sink, there are major differences in what is happening block by block and even in certain subtypes, which is why I've mentioned condos and townhouses really struggling. With no distinguishing features and a lot of the same on the market, sellers are stuck competing for more with more and more motivation. However, properties with unique value propositions in good locations are selling better than ever at higher prices than ever, which is why we can see crashes in some areas, but in some, not so much. Here's a comment from one of my recent videos. Friends just bought in Brentwood and won the bidding war. So much for dropping prices. So now we have to ask, when will the money printing ramp up? Now, it's unclear what Trump even meant by his comment. If taken literally, this could be double the impact of the biggest QE that the Fed's ever done. If he really, really is serious, then bond auctions are going to be canceled. And that seems far-fetched, but we don't know. We don't know what he's going to do at this point. Andy Constant is probably one of the best thinkers on this subject. He says that Secretary Bessent has been outspoken about the prior administration's use to stimulate the economy. He's talking about debt. And yet the Trump administration is going to continue this policy and maybe even increase it. And this is what he says will happen. A run-it-hot economy is likely to keep those who do not have asset wealth or borrowing capacity employed. Unfortunately, they are highly unlikely to see real wage gains, and their standards of living will decline. This is actually very sad, as neither political party appears to have the will to do what we need to do to get this country on the right financial footing. And with this stance, the value of the dollar will continue to decline, while assets like housing and stocks will stay elevated. It's a policy choice. It's always been a policy choice. Anyone that can guarantee that they know what's going to happen, even in housing, has no idea. It's based on policy. They can print trillions and pump it into assets at the expense of the working class. And unfortunately for now, that's the direction that it appears to be heading. Now, it can change at any time, and I hope it does. Ray Dalio warns about these scenarios, and he gives excellent advice at the end of Principles of Dealing with the Changing World Order. Earn more than we spend and treat each other well. And I hope that's the path we choose. Thanks for watching. I look forward to seeing you next Saturday.